Okay, dear students, this is Mustafa Mirchawala from Mirchawala Institute of Accountancy, your FR trainer. Hope you all are fine and hope you all are working hard for your upcoming FR exam. The objective of today's session is not just to solve the past paper, although we'll be doing the latest past paper, but the objective is not just solving the past paper. The objective is to transfer confidence, because I think I have recorded all the past papers, I have recorded, and even I have posted many on YouTube as well. So before the last attempt, all attempts have already been recorded. So in this age, in this time, you have a lot of extraordinary lectures available, but the major thing is confidence. And many students, the voice is perfect, I think. How is the voice? Please tell me. Can you hear me? Yes, voice is fine. Oh, so normally students study in the last 40 days, 45 days, 35 days. This is the routine. This is the reality. No matter, there are students, they start the course 3 months before, but the real studies they do in last 30, 40 days. So these are the tough times, and in these times there are students, there are your friends who demotivates you, who gives you another picture that this paper is very difficult, we can't clear, and all negative thoughts. Okay, so first thing is stay away from negative thoughts, and especially stay away from negative WhatsApp groups as well. Okay, so because all the hard work you have done, it will become zero. It will be multiplied by zero if you meet with negative people. Okay, so if you have completed the course by now, I'm sure, and that's my positive behavior, that my optimistic approach, that all of you have completed the course by now. Okay, because to clear the exam, the first thing is you complete your course on right time, right? And then these are the times of revision days. These are the times when you read the article, especially you read the examiner report. Especially I emphasize on examiner report, because in examiner report, examiner discusses many of the recent attempt mistakes by students, so that you don't repeat those mistakes. Okay, so must give time, at least 3 to 4 hours take, or half day for the examiner report reading, right? Do solve the mock exams as well. Mock exam is must thing. Mock exam is must thing. Okay, right? We'll also send you the mock exam. So must solve the mock exam, because what students do, they just do separate questions. They just do few MCQs and then they go away. Then they go few MTQs, then they opt MTQs, then they go away. But in the examination, you have to complete whole paper in one go. So you must practice this complete realistic war also. Okay. Now, whatever you are studying, whatever lectures you studied, whatever revision days you studied, whatever marking facility you availed in ratio analysis, because we give this marking facility, the same facility is availed by the last attempt students. They all availed the same, and they also scored these scores. See, this is just for your motivation, and I'm not showing you 3-4 years back result. This is the very latest attempt results, just for your motivation. So these people are also common people, normal common people, and they were also like you. So if they can do it, why can't you? So simply think positive. And this paper has a very good pass rate. And this paper is a history that normally after completing part one, the first paper students opt is F7. This is the history of ACCA. The first paper students opt is F7. This is the normal routine. Okay. Right. So now we are moving towards the latest past paper, that is September-December 2022 attempt. It's available on your accaglobal.com. I request you all to please switch off your camera, so that our recordings don't disturb. Okay, so this is the latest September-December 2022 past paper. All previous past papers have been done. Okay, one more thing. In section C, there are 2 questions. Somebody is asking about section C. You get 2 questions of 20 marks each. In section C, you get 2 questions of 20 marks. That means 40 marks. One more thing, I have told this in my previous webinars as well, in my classes as well, that this was announced by in one of our training we attended from ACCA, that the reason for failure of students in applied skills module is last 40 marks. Normally students fail, or normally students, those who score low, the reason is last 40 marks. So it's better you emphasize on last 40 marks and practice last 40 marks, okay, appropriately. So the first question we are doing is consolidated income statement. The first question we are doing is consolidated income statement. The major thing is consolidated income statement, okay? And there will be one requirement. In the last requirement, there will be something of consolidated SOFP. Okay, before we move on, before we start, let me tell you one thing. We have sent in our admin has sent in your chat box, there is a link of WhatsApp group. There is a link of WhatsApp group. Please join that WhatsApp group, okay, so that I can send you more webinars and more resources in that group, okay. Kindly all of you join the WhatsApp group. Now, before I start consolidated income statement, all of you look at me. Now these next 2 hours are very sensitive for you, very important. You are doing exam preparation. Just think you are doing exam preparation. So when sometimes in advanced, this is not advanced level, F7 is intermediate level. When I teach strategic level, SBR level, or ICAEW corporate reporting level, and in those classes, sometime I have to revise this consolidated income statement in 2 minutes. Consolidated income statement in 2 minutes. Sometime we need to revise consolidated income statement in just 2 minutes. So I just use this technique. Look at me. Listen, let us say this white pen. Can you see this white pen? Let us say this white pen is parent company's income statement. This white pen is parent company's income statement, and this is S company's. This mobile phone is S company's income statement. Okay, listen. So whenever, if there is a problem in parent company's income statement, there is some expenses issue or incomes issue in parent company's income statement, that issue will go in consolidated income statement only. If there is a problem in parent company's income statement, like any expense issue or income issue or any issue in parent company's income statement, so obviously we add parent and subsidiary, so that problem will only go in consolidated income statement. So you need to adjust consolidated income statement for that. Okay, I repeat last time, whenever there is an issue in parent company's income statement, this issue will automatically go in consolidated income statement, and you need to adjust. But let us say this mobile phone is S company's income statement. This mobile phone is S company's income statement. So whenever there is a problem in S company's income statement, my dear students, so this problem will not only go in consolidated income statement, but this problem will also go in NCI, because S company's profit after tax is used to calculate NCI. Okay, so do remember this thing. Whenever there is a problem in parent company's income statement, this problem will only solve in consolidated income statement. But whenever there is an issue in S company's income statement, this problem will be solved at 2 places. First, consolidated income statement, and second, NCI. This is the key. Those who know this thing, they can do all questions of consolidated income statement. Okay, right? Now, one more thing. Keep this thing in mind, that income statement is a for the year thing, and SOFP is as at. Income statement is a for the year thing, and SOFP is as at. Okay, now listen here. This scenario relates to 2 requirements. PERT company acquired 80% of Sept-Dec company on 1st April X6. This is the acquisition date. Concentrate, please. Now, can you tell me non-controlling interest is valued at fair value? It's full goodwill method. is full goodwill method. Okay, now listen. Extracts from draft financial statement of both entities are as follows. Now see for which year we have to make income statement. For which year we have to make income statement, that is 31st March X8. 31st March X8. But we acquired company on 1st April X6. That means there is a 2 years gap. There is a 2 years gap between acquisition date and reporting date. Okay. But we have to prepare income statement just for the second year. And you know what's our accounting period? Look, let me tell you our accounting period. Our accounting period is 1st April X7 to 31st of March X8. This is our accounting period. Keep this period in your mind during this whole question. Okay. So now you have revenues, cost of sales, everything is in front of you. And then they have given you total assets. They have given you total assets. This total asset thing will be used in the second requirement because they will be asking you something regarding SOFP, but right now it's not the case. Now, next, the cost. Now, one more thing. That's what I expect from you. You all have done normal course, so you know many things now. Please, you have your exam in 15 days. So please don't sit like idle. The cost of PERD's investment, this is COI. The cost of PERD's investment, which means cost of investment in subsidiary company, has been excluded from the total assets. That's a good news. See, in these total assets, investment has already been knocked out. And you know, when you make consolidated SOFP, you cancel the investment. Whenever you make consolidated SOFP, you cancel the investment, you cancel out the investment, okay? Right? So it has already been excluded. That's a good news. As a part of consideration for Sept-Dec company, 8 million is due to be paid on 1st April X8. So this is deferred consideration. See, all of you just think our takeover date was this 1st April X6. Our takeover date was 1st April X6, but we need to make one payment on 1st April X8. After 2 years, we have to pay parent company promised to pay a certain amount to S company's shareholders after 2 years. So this is what we call deferred consideration. This is what we call deferred consideration. And you know, all obligations which are payable more than 1 year or after, we need to discount. We need to discount and we need to bring to present value. So deferred consideration, we bring it to present value, and then we calculate unwinding of discount. Remember? So keep that thing in your mind. PERD company recorded, PERD means parent company, recorded a liability of 7.547 in its individual financial statement at 31st March X7, which correctly represents the liability at that date. Okay. So they have done 1 year accounting. They have done 1 year accounting. Open your eyes. They have done 1 year accounting, but the second year accounting we have to do. No other accounting entries have been made in relation to this consideration for the year ended 31st March X8. PERD company's cost of capital is 6%. PERD company's cost of capital is 6%. All of you, please turn off your cameras. I have told you many times. Okay. Now just read this. Don't worry, I'll explain through sketch. Just read this first paragraph and think over it. All of you, it's like you are solving your real exam, and this is your latest exam. So look at here. See this, simple. Your accounting period is 31st March X8 and your acquisition date is this. So parent company promised S company's shareholders. Parent companies promised S company's shareholders to give a certain amount of here on 1st April X8. So definitely parent company have calculated this liability at present value. Parent company initially calculated this liability at present value, and yes, then parent company did 1 year unwinding of discount. Parent company did 1 year unwinding of discount, and they have given you updated liability. They have given you updated liability on 1st April X7. Now, you just have to do this year work. You just have to do this year work. You just have to do this year work. Okay, right? So how you will do it? So see, the interest rate, cost of capital is 6%. So can you multiply 7.547 multiplied by 6%? This second year, your outstanding loan, this second year, your outstanding loan is 7.547. 7.547. Can you multiply it by 6%? What is the amount? Please tell me. And let me see, the question is in thousands. Yes, the question is in thousand. So it's 7547. This will be 7547. Okay. 452.8, 453. So this will be 453 interest expense debit, 453, and DC credit. The entry is not needed. Just for your reference, I am making the entry. So interest expense debit and deferred consideration credit. That's it. Nothing else. Interest expense debit and deferred consideration credit. Now, use your common sense. See, parent company promised S company shareholders about this consideration. Parent company promised S company shareholders about this consideration. Parent company promised S company shareholders about this consideration. So this is the loan on P company. This is the loan on P company. When this is the loan on P company, then this interest expense also belongs to P company. This interest expense also belongs to P company. So now when this, I gave you the concept at the beginning. When this interest expense only belongs to P company, so it will only go in consolidated income statement. Yes, this will go in the finance cost section of consolidated income statement. This will increase the finance cost of consolidated income statement. As a student, you may ask, sir, won't it go with the NCI? No. This is not the S company's expense. Only S company's income and expenses affects NCI. Only S company's income and expenses affects NCI. Parent company's income and expenses never affects NCI. Okay. So this is your first paragraph and it is done. Your first paragraph is 453 is the interest expense and it is done. See, let me just, for your help, let me just write 453 will come here. 453 will come in this finance cost section. Okay. 453 will come in this finance cost section. 453 will come in this finance cost section. Okay. Right. Now, the next thing, next para. On acquisition of Sept-Dec company, the goodwill was correctly calculated 3.2 million. Initially, at the date of takeover, the goodwill was 3.2 million. In the year ended 31st March X7, goodwill was deemed to have impaired by 400. In the first year, there is an impairment of 400. A further impairment of 300 is to be recognized for the year ended 31st March X8. Impairment losses are charged to operating expenses. Now, this is very good. My dear student, open your eyes and think over it. That goodwill, we are studying income statement. And income statement is always for the year. So in your for the year income statement, second year income statement, what amount of expense you will post? What amount of expense you will post? You will post this 300,000. Okay. In your year ended 31st March X8, your expense is 300. So it will go in the income statement as 300. Now, how you will post? Now you tell me, this is goodwill, full goodwill method or proportionate method? Come on, full goodwill method or proportionate method? Full goodwill. So in full goodwill method, goodwill belongs to S company. Goodwill is considered to be a complete asset of S company. And when a complete asset of S companies goes down, so it is considered as an expense of S company. So when it is considered as an expense of S company, so it will not only hit the consolidated income statement, but it will also hit the NCI working as well. So first thing, this 300 will be added. This 300 will be added in consolidated operating expenses, number one. And number two, it will be deducted as it is an expense. As it is an expense, it will be deducted from NCI working. It will be deducted from S company's profit after tax in the calculation of NCI, okay? Right? Now, this topic is not over, because in the second requirement you will be needing to calculate the SOFP as well. as well. And your teacher always teach you this thing, that SOFP is always as at. SOFP is always as at. Let me explain you one thing. Listen to me. Look at here, all of you. See, this is 1st April X6. This is 1st April X7. And this is 31st March X8. All of you listen carefully now, because right now I'm using pen, but soon I'll be shifted to Excel. Soon I'll shift to Excel there, and in laptop I won't have pen. So understand things now, and then I'll only solve that thing. See, initially when you took over the company, your goodwill was 3.2 million. That is 3,200. Initially, when we took over this company, our goodwill was 3,200. In the first year, there is an impairment of 400. In the second year, there is an impairment of 300. Now, can anybody tell me, if I prepare SOFP, can anybody tell me, if I prepare SOFP as at 31st March X8, how much goodwill should I post in total assets? How much goodwill should I post? Yes, very good. Excellent. 3,200 minus 4 minus 3, 2,500. Okay. So in the second requirement, see, this is the second requirement you can see on the screen. When I'll be doing the second requirement, I'll post 2,500 goodwill. And how I will post 2,500? By deducting 3,200 minus 400, 3,200 minus 400 minus 300, 3,200 minus 400 minus 300. I hope you got the point. Okay. So now let's move to the next one. Now, in my eyes, I'm a teacher. In my eyes, this third requirement is the heart of this question. This third requirement is the heart of this question. If you understand this requirement, the whole question is just a gupshup. Okay. If you understand this is the technical requirement. Now, at 1st April X6, see, this means takeover date, acquisition date. 1st April X6 means acquisition date. Sept-Dec company's property had a carrying amount of 11 million, but a fair value of 14 million. Okay. At this date, see, there is a 3 million fair value adjustment. 3 million means 3,000. 3 million means 3,000. 3 million means 3,000. Okay. At this date, the property had a remaining life of 15 years. Through this 15 years, you will be calculating excess depreciation. Hope you remember. So there is a 3,000 fair value adjustment. Hope you remember the fair value adjustment. Sept-Dec company sold the property, first time, for 15 million on 30th September X7. That means mid of our current year. Don't worry about it. I'll make the sketch as well. Don't worry. For the year ended 31st March X8, Sept-Dec company recorded the historic cost depreciation and historic cost profit on disposal in operating expenses. This is the key. See, everything what they are doing in operating expenses. So we don't need to adjust cost of sales this time. We don't need to adjust cost of sales. Although I have taught you, when I teach this excess depreciation in cost of sales because this is the standard. But right now, examiner is openly saying that this transaction belongs to operating expenses. So now you have to listen the examiner. Now you need to listen the examiner. Okay. So we will adjust this transaction in operating expenses. Depreciation is charged on a pro rata basis. Now, giving you 30 seconds just to read this transaction again. Read it again. Concentrate, please. Think over it. Okay. Let me explain you now. Let me add few zeros in it. This is 11,000. This is 14,000. Now wait. Sorry. This is also 14,000. This is 11,000. Okay. So first of all, only thing which I demand is concentration. I will repeat. Don't worry, I'll repeat, but I need your involvement, please. This is the acquisition date. When acquisition date, P company acquired S company, the value of this property, plant and equipment in S company's book was 11,000. This is S company. But from the group point of view, we bring it to fair value. So from group point of view, we brought it to 14,000. Now, you know one very important thing about this fair value adjustment, S company people don't know. That means in the individual books of S company, this asset is still at 11,000. But yes, from group, open your eyes and ears. From group point of view, the value is 14,000. From group point of view, the value is 14,000. From group point of view, the value is 14,000. Okay. Now, first of all, forget everything. You know, we have to adjust the excess depreciation. We have to adjust the excess depreciation in the income statement. So how much is the difference? The difference is 3,000. Listen, the difference is 3,000. The difference is 3,000 divided by what is the remaining life? 15 years. 15 years is the remaining life. So 3,000 divided by 15 years is how much? 200. This 200 is per annum. This 200 is per annum. All of you open your eyes. This 200 is per annum. Okay. This 200 is per annum. But you know, this is your accounting period. We are making income statement. This is 200 or 400. It's 200, right? It's 200 per annum. Let me tell. Wait. We are solving first of all, concentrate on income statement. We are solving income statement for this year. See, this is our year. 1st April X7 to 31st March X8. 1st April X7 to 31st March X8. And you know, S company sold this asset in 30th September. So in this our accounting period, in the year ended 31st March X8, in the year ended 31st March X8, we use this asset for only 6 months. The group use the asset for only 6 months. So only 6 months excess depreciation will be adjusted. Only 6 months excess depreciation will be adjusted. And what is 6 months excess depreciation? Look at here, 200 into 6 upon 12, 100. So first of all the class members agree on one thing, that we need to adjust the excess depreciation of 100. We need to adjust the excess depreciation of 100. And yes, this is upward fair value adjustment. This is upward fair value adjustment. My dear student, when I teach in the class, I make the notes for this. Even I make the notes for these steps. So for upward fair value adjustment, see, just think, S company people booked low expense S company people book low expense, but from group point of view, we need to book extra expense. So now we will book more expense now in the consolidated books. So we will increase the operating expenses. We will increase the consolidated operating expenses by 100. We will increase the consolidated operating expenses by 100, one thing. And second thing, as this asset belong to S company, so we need to adjust NCI. We need to adjust NCI. And as this is an expense transaction, so NCI will be deducted. NCI will be deducted. That means from S company's profit after tax, we'll deduct this £100 in order to calculate NCI. So first of all of you agree on one thing, that we need to adjust excess depreciation for 6 months only. We need to adjust excess depreciation for 6 months only. We need to adjust excess depreciation for 6 months only. Okay. Are you guys agreed for this? So this excess depreciation will be adjusted for sure in operating expenses and in NCI. All of you agreed? Please write on the chat box. All of you agreed, yes or no? Okay, now thanks. Now one more thing. First time in your exams, examiners sold the asset of upward fair value adjustment. Normally what they do, they just do upward fair value adjustment and you just adjust excess depreciation. Now they have sold it. So we need to adjust the issue between individual books and consolidated books. See, right now in our requirement, we are doing group accounts. We are doing group accounts. We are doing consolidated books. We are preparing consolidated income statement. Okay. So we have to do everything from group point of view. We have to do everything from group point of view. Okay. Listen to me now. So first of all, in the eyes of S company, see, I have made a line. I have made a dark line. Can you see? Look at here. In the eyes of S company, this asset was 11,000. In the eyes of S company, this asset was 11,000 on 1st April X6. So now S company, what S company did in their individual books. So 11,000 divided by 15. In this year, they book 733. And then in the next year, they book 367. 367. I repeat, listen. 11,000 divided by, this is S company's books. 11,000 divided by 15, 733 per annum depreciation S company people booked in last year. And this year they have booked 50%, obviously half. So can you do 733 divided by 2? Can you do yourself 733 divided by 2? It will be 367. So now in the books of S company, there will be an NBV of 9,900. In the books of S company, there will be an NBV of 9,900. And this NBV is calculated using the historic cost, not the fair value. This NBV is calculated using the historic cost. So it was written in the question that when they sold for 15 million, 15 million means 15,000. When they sold this asset for 15 million means 15,000, they booked the gain. They booked the gain on disposal using the historical cost. So 9,900 compare the 9,900 and 15,000. The S company's NBV was 9,900 and they sold it for 15,000. So they book gain on disposal of 5,100. Now use your brain. This gain they already booked. Right? But now calculate the gain on disposal which should have been booked. Now calculate the gain on disposal which should have been booked. Now listen to me. See the upper part above this. From the group point of view, this asset was 14,000. From the group point of view, this asset was 14,000 from the day one. So 14,000 divided by 15. 14,000 divided by 15 from the group point of view, depreciation should have been 933 per annum. Okay. And 933 divided by 2 is 4,667. Listen, my dear student, 467. Now 1 year depreciation from group point of view is 14,000 divided by 15 years is 933. And the next year, obviously, we sold in the mid of the year. So 933 divided by 2, half year, it's 467. Can anybody calculate the NBV from the group point of view? It will be 14,000 minus 933 minus 967. It's 12,600. Okay. So this is the group NBV. From group point of view, the NBV should be 12,600. From group point of view, NBV should be 12,600. Now calculate one more game. From the group point of view, the NBV should be 12,600 and we sold it for 15,000. We sold it for 15,000. So now can you compare 12,600 and 15,000 difference? From group point of view, only 2,400 gain on disposal should be booked. Only 2,400 gain on disposal should be booked. Now, all of you open your eyes. They did book this gain on disposal. They did book this gain on disposal, but they should have booked this gain on disposal. They did book 5,100 as a gain on disposal, but they should have booked only 2,400. That means take the difference. All of you, please take the difference of 2,700. Yes, that means 2,700. They booked extra. They booked extra gain of 2,700. They booked extra gain of 2,700. They booked extra gain of 2,700 in operating expenses. They booked extra gain means income. Gain means income of 2,700. Now use your brain. Now use your brain, please. When they book extra income, so now in order to cancel it, we'll book extra expense. They booked extra income of 2,700. Now, in order to cancel it, we'll book extra expense. And extra expense means now we'll increase our operating expenses by 2,700. We will increase our operating expenses by 2,700. We will increase our operating expenses by 2,700. That's it. One more thing. As this asset belongs to S company, so NCI will also be adjusted. So what I'm saying, as we are increasing the operating expense, so profit will go down. So in the calculation of NCI, we'll deduct 2,700 from S company's profit after tax in the calculation of NCI. That's it. My students, I've taught in detail. Now you must pick up. You must pick up because you have your exam in 15 days. I hope you understood it. So in this whole transaction, we need to adjust two things. Number one, $100 excess depreciation. And number two is 2,700 gain on disposal reversal. Yes, you will get the recording, don't worry. Did you understand it? My dear students? Please write on the chat box. This was the real transaction. The all remaining transaction is just time pass. Now, let's move. Listen, dear student, excess depreciation will be added in operating expenses, number one. And number two, it will be deducted from S company's profit after tax in the calculation of NCI. Next. Now, point number 4 is basic F3 level P2S sale. Third company made sales of 9 million to Sept-Dec company during the year ended 31st March. This is baby transaction. Please, this is bonus marks. So P2S sale of 9 million. Sept-Dec company had only paid 2 million of these goods. Yes, this is about the cancellation of receivable and payable. I'll teach you, don't worry. These sales were made at a markup on cost of 25%. Markup is profit percentage on cost. and Sept-Dec company holds one third of these goods at 31st March X8. To be very honest, those who studied honestly, they can smash this transaction. To be what's this transaction? P2S sale, basic F3 level. It's total F3. Yes, some students have calculated me URP. Some students are sending me URP on the chat box. Okay, let me do it. See, P company sold goods to S company for 9,000. Now first write SCP, first calculate total profit. And I teach in this way, SCP. Sales is 9,000. And in this question, there is a 25% markup. 25% markup, you know, in markup is profit percentage on cost. So in markup, cost is always 100%. Profit is 25. So this will be 125. This will be 125. Now, my dear student, what you will do? 9,000 divided by 125 into 25. 9,000 divided by 125 into 25. How much is this? 9,000 divided by 125. It's 1,800. And the cost is 7,200. So the story is P company bought this inventory for 7,200 and sold it for 9,000. So this is the total profit. This is the total profit. Total profit is how much? 1,800. 1,800 is your total profit. Now, you know what is the step to calculate URP? First of all, we calculate total profit, and then we ask one question. What is the question? How much goods are unsold at the year end? How much goods are unsold at the year end? It's 1/3. It's 1/3. So 600 is your URP. Now, take baby steps. If there is a question of P2S sale in income statement, if there is a question of P2S sale in income statement, then how you solve it? First of all, whatever is the amount of transaction between these two companies, we deduct it from consolidated sales and consolidated cost of sales. I repeat, that means 9,000 will be deducted. 9,000 will be deducted from consolidated sales and consolidated cost of sales. 9,000 will be deducted from consolidated sales and consolidated cost of sales, consolidated sales and consolidated cost of sales. Okay. Number two, this URP will be added. This URP will be added in consolidated cost of sales. This URP will be added in consolidated cost of sales, right? Okay, just two steps. No NCI. As this is P2S sale, no NCI adjustment. No NCI adjustment. So I repeat, consolidated sales and cost of sales will be reduced by 9,000, and this 600 URP will be added in consolidated cost of sales. That's it. That's it. Now one last thing. See, now I'm talking about the balance sheet. SOFP. SOFP. P company sold goods to S company for 9,000. P company sold goods to S company for 9,000. So automatically, obviously, parent company is demanding 9,000 from S company. But by the end of the year, S company only sent 2,000 to P company. Okay, so that means there is a 7,000 intra-group receivable. There is a 7,000 intra-group receivable. There is a receivable of 7,000 in P company books, and there is a payable of 7,000 in S company books, because out of 9,000 only 2,000 is paid. So there is a 7,000 intra-company receivable and payable, right? So this we need to cancel out. This we need to cancel out. Okay. Now, my dear student, please use your brain. Use your brain. When you cancel this intra-group receivable and payable, so obviously in this cancellation, there is one receivable as well. In this cancellation, there is one receivable as well, and receivable comes on the asset side. Receivable comes on the asset side of the consolidated SOFP. So that means in the requirement B, when you will be doing adding together of assets, you need to cancel out, you need to reduce the total assets by 7,000. You need to cancel out the total assets by 7,000. Okay. Yes, as well. I repeat. So as we have to do consolidated dated SOFP asset side as well. In this question, as we have to solve consolidated SOFP asset side as well. So one thing is the receivable cancellation and second thing is URP. Yes, URP is deducted from consolidated group inventory as well. URP is deducted from group inventory as well, and group inventory comes on the asset side. So in the asset side, this thing and this thing will be deducted. Don't forget this receivable cancellation and this SOFP calculation on the asset side as well. Yes, also in CR as well, but in this question they are not asking you the CR, my dear student. Somebody is asking only asset side you have to make. They are just testing your concept. Let me show you. See the requirement B. All of you please read the requirement. Calculate the total asset that would be recognized in the consolidated statement of financial position for the PERT group for 31st March X8. So in the asset side, receivable cancellation will be there and URP, obviously you will have to deduct. Now note number 5. Note number 5. At 31st March X8, again, this is easy. This is revaluation, upward revaluation. The PERT group decided to revalue. That means at the year end, after 2 years, takeover date was 1st April X6 and this is 31st March X8. That means after almost 2 years. So this is not a fair value adjustment. This is a normal post revaluation. At 31st March X8, PERT group decided to revalue its non-current assets for the first time. PERT company's assets were deemed to have increased by 4.1 million and Sept-Dec's company's asset by 0.7 million. Okay, so P company's asset revalued by 4.1 and S company's asset revalued by 0.7. Neither company has recorded the revaluation in its individual financial statement. Thank God, ignore deferred tax. So we all know you have done final accounts. You have done final accounts. You know, upward revaluation of non-current assets goes in OCI section. OCI. Remember the OCI? So 4.1 and 0.7. So first of all, when you will be doing adding together, when you will be doing adding together like as if you own everything, when you will be doing adding together like as if you own everything, then you have to add complete. You have to add complete 4.1 and 0.7 million. Complete 4.1 and 0.7 million. Okay. But yes, later on, only this thing, this 0.7 million, this 0.7 million which relate to S companies, this will also hit the NCI calculation. This will also hit the NCI calculation, but this 4.1 million purely belongs to P company. This 4.1 million purely belongs to P company, so it will not be part of NCI. But yes, this 0.7 million, as we have holding of 80-20, we have holding of 80-20, so 20% will be adjusted. 20% of this 0.7 million will be adjusted in NCI, will be adjusted in NCI. Okay, one more thing. See, just use your common sense. Just use your common sense. Upward revaluation also increase your assets. You know that asset debit and revaluation reserve credit, you make this entry and PP debit and OCI credit or revaluation reserve credit. So upward revaluation will also increase your asset. And in the question it is written, they have not even yet recorded this revaluation. So yes, see this. It will also go in the last requirement. It will also come in the last requirement, this 4.1 and 0.7 on the asset side, exact 4.1 plus 0.7, 4100 plus 700, 4100 plus 700, 4800 will also go in the asset side as well. Okay. Now, my respectable students, now last requirement is again piece of cake. Cake, eat it. Substance company paid a dividend of 1 million, total dividend of 1 million, which has correctly been recorded by both companies. Now, wait. See, this is P and this is S company. P company holds 80% of S company. That means P company is the 80% owner of S company. P company is the 80% owner of S company. Okay. So S company this time given total dividends of 1000. S company will give total dividend of 1000. So out of this total dividend, 20% will go to NCI home and 80% means 800 will come to P company. Out of this 1000 total dividends, 800 will come to P companies. So it's P company is the investor. The name of P company is basically investor. So when P company is the investor, so this 800 is the investment income. This 800 is investment income of parent company. Okay. And it is written in the question that both companies have correctly recorded. Both companies have correctly recorded this transaction. That means parent company has recorded this 800 in his investment income. Parent company has recorded 800 in his investment income. See. So can you see this investment income, my dear student? There is a total investment income of 3000. You have to deduct 800. Now, when I'll be doing my Excel work, I'll deduct 800. I'll deduct 800. I'll deduct 800. Okay. I'll be deducting 800. 80%. Somebody is asking, how did we get 800? Because our holding is 80%. Students, look at here. 80% here. See, our holding is 80%. Our holding is 80%. Our holding is 80%. Okay. So yes, we have done all the requirements. We have, yes, why? Because it's intra-group transaction within the group. These dividends, see this. These S company gave 1000 dividend, and out of 1000, 80% holding is of P company. 80% holding is of P company. Okay. Okay. Yes, receivable point. Very simple. Parent company sold goods to S company for 9000. Parent company sold goods to S company for 9000. So this is very common sense that parent company will be asking 9000 from S company. But it is written in the question that S company paid 2000. Out of 9000, S company paid 2000 to P company before year end. So out of 9000, when 2000 is paid, so how much is unpaid? Unpaid is 7000. So that means 7000 is payable in S company's books and 7000 is receivable in parent company's books. So as this is intra-group transaction, we need to cancel these receivables and payables. Now, my first request, listen. First of all, take the picture of this question. Take the picture of this question, because now I'll move the screen. There will be no question available to you guys. Listen. Take the picture of this question, because now I'm shifting to Excel. Remaining 200 dividend belongs to NCA, but we ignore it. We ignore it. See, this is the question. This is the take the picture. Take the picture of question. I'm telling you last time, please, because I'm going to shift. I'm going to shift the screen. Also take the picture of this. Also take the picture of this, please. Take the picture of this question as well, okay? Because now I'm going to shift the screen. Thank you. I hope you can see the screen. I hope you can see the screen. Okay. Now, my dear students, for my convenience and because for to save the time and my convenience, I have written something already because it's not my objective to teach you how to type revenue. This is not my objective. You are no more kids. It's not my objective to teach you how to write revenue, how to write cost of sales. No, that's not my objective. So my objective is to make you understand this topic. Okay. So now we are starting consolidated income statement. But first message, listen, income statement is always for the year. Income statement is always for the year. Okay. So you need to start adding together and you need to adjust things which I told you. Okay. So first of all, I'm writing here. I will be doing, I'll write everything twice. So revenue is how much? 58,200. 58,200 plus 34,300. This is S company. And now you remember there was intra-group sales of 9,000. So simply deducted minus 9,000. Now see this. Now I'll be applying the formula. Here. Okay. I'll write equal to, and I'm writing everything there. 58,200 plus 34,300 minus 9,000. 83,500. 83,500 is your sales. Okay. Now come to the cost of sales. Let me increase the screen. Wait. Is it okay now? I think let me enlarge the screen so it will be visible for you. Now let's come to Now let's come to cost of sales. For cost of sales, we have 34,340 plus 20400 minus 9,000, the intra-group sales. And yes, there was a URP. Students. URP of how much? URP was 600 plus 600. Okay. So now let's do it here. Equal 34,340 plus 20400 minus 9,000 plus 600. Okay, just one mistake I didn't subtract it, but it okay. I can do it like that, equal to this minus this. So this is 37160 is your gross profit. 37160 is your gross profit. 37160 is your gross profit. Please try to understand. I have explained you everything in very depth. So now I will only solve it. Okay, I have explained you everything. Now for come to operating expenses. How much operating expenses we have? Let's do a working for operating expenses. Listen, look at here. What is the PERT company's operating expenses? Can anybody tell me? 180. PERT company's operating expenses are 18040. Parent company's operating expenses are 18040. And what about the S company's operating expenses? It's 7130. Keep the quest. Sorry, let me write on the next. 7130. Now, next thing. Listen. how many things we need to adjust in operating expenses. Remember, there was an impairment for the year. There was an impairment for the year of 300. So we need to adjust impairment. We need to add. Impairment is already an expense, so it will increase your operating expenses. Then fair value adjustment is fair value adjustment, depreciation, excess depreciation. Excess depreciation is also an expense, so it will increase. And you remember the adjustment of gain on disposal, adjustment of gain on disposal of 2700, because S company booked extra gain on disposal. S company booked extra gain on disposal of 2700. So now we need to book extra expense. We need to book extra expense. Okay. So let's add all of them. So it will be 28270. Your total operating expenses, your total operating expenses will be 28270, right? Now simply write operating expenses in that section. Simply write operating expenses. Can anybody tell me what is the cell number? See the cell number. It's D51. D51 is the cell number. I'll write there and this will be posted there. D51 is the cell number for this. Okay. Look at here. Equal to minus D51. That's it. Operating expenses. Now come to investment income. Profit from operations. How much is the profit from operations? $8890 is your profit from operations. Now come to the investment income. Already the investment income was 3000, but I just told you we need to cancel out 800 dividend income. I just told you we need to cancel out 800 dividend income. So minus 800. So this will be 2200. Okay. Now next thing is finance cost. Already your finance cost is 3240 for parent company. Then you have 1600 for S company, 1600 for S company. Then you have 453 was unwinding of discount. Remember, I taught you this 453 of unwinding of discount. So let's adjust. Equal 3240 plus 1600 plus 453, 5293. Okay. Now you need to deduct, wait. $5293 in the negative sign, Now the next thing is profit before tax. Look at here. This will be 8890. It's 5797. Now come to the tax expense. Tax expense is how much? It's 4100. It's 1560 plus 1480 Okay. So let's do it. It will become 3040. Okay. Now let's calculate profit for the year. Let's calculate profit for the year. It's 2757. 2757 is profit for the year. Now, hope you remember, my dear student, the rules of income statement. Right now, we are doing like as if we own everything. I say one word in Hindi or Urdu. We are doing like hummy hum, right? Remember? So the way you are doing till profit for the year, you have to do for total comprehensive income as well. So you know there was some gain on revaluation. There was some upward revaluation for both companies, parent and subsidiary. Parent was 4100, and subsidiary company was 700. So right now you will simply add total amount. You will simply add total amount. So 4100 plus 700 will give you 4800. Now, can you tell me what will be your total comprehensive income? What will be your total comprehensive income? This will be 7557. Now wait, let me bold it. You have done a major work. You have done, we have done a major work. Okay. Now we have to write 3 lines 2 times. We have to write 3 lines 2 times. This is profit attributable line and then total comprehensive attributable income line. Profit attributable line and total comprehensive attributable income line. Okay. Right. You have to line 3 lines 2 times. But before we move on, first, giving you just 1 minute, look at the screen, see this adding together. Look at the screen and see this adding together. Now, first of all, we need to calculate NCI for profit. We need to calculate NCI for profit, and then we need to calculate NCI for total comprehensive income. Just you need little bit energy, and this question will be done. And I'll give you break. After this question, I'll give you break and then we'll move on to ratios. Don't worry. Please just concentrate 5 minutes. Pure full-time concentration. So now you need to calculate NCI for profit using profit and then NCI using total comprehensive income. Okay. My dear student, I told you to take the picture of the question. I told you to take the picture of the question. Look at here. Let me go to the working section. Listen. Can anybody tell me what is, this is working of NCI. This is working of NCI. What is S company's profit after tax? S company's profit after tax is, S company's profit after tax is, wait. S company's profit after tax is 3690. 3690. Now start adjusting. The first thing is, you know, we booked extra gain on disposal of 2700. So we need to reverse it. We need to reverse it, like we have to book expense now. And when we'll book expense, we need to subtract. So 2700. Second thing is excess depreciation of upward fair value adjustment. Excess depreciation of upward fair value adjustment is also an expense. So expense will reduce the profit. Then we have for the year goodwill impairment. We have for the year goodwill impairment of upward fair value adjustment. For the year goodwill impairment of upward fair value adjustment, this is also an expense. So can you tell me what is the total profit is 590. The total profit for NCI is 590. And now tell me what's your holding percentage. Our holding percentage is 20%. Our holding percentage is 20%. So simply multiply it by, sorry, NCI holding percentage is 20. So simply multiply it by 0.2. So yes, this is your NCI for profit. This is your NCI share for profit 118. Don't forget NCI share for profit. Now, finally, we have to calculate. Finally, we have to calculate NCI share for total comprehensive income. NCI share for total comprehensive income. Student, please, just few minutes. How we calculate total comprehensive income? You remember final account? You remember final account? In final account, you used to calculate total comprehensive income by adding OCI in profit. OCI in profit after tax. So this is C. This is this 118. This 118. This 118 is your profit share. Now tell me how much OCI belongs to S company. How much OCI belongs to S company? It's 700. You know, 700 of the revaluation. 700 of the revaluation belong to S company. So you will write 700 multiply 20%. 700 multiply by 20% here. Okay. So this will be 140. 700 multiplied by 20% is 140. So what will be NCI share for total comprehensive income? It will be 258. It will be 258. Okay. So I have calculated both. See, these both bold numbers are relevant for you. These both bold numbers are relevant for you. Think over it calmly and relax, please. Now listen. This is cell D60 and this is D64. D60 is the profit and D64 is total comprehensive income. Let's do it. Now look at the screen. Look at the screen, please. Now, profit attributable to. First of all, can anybody tell me what is the total profit? It's 2757. Total profit is 2757. Just let me copy paste it. It's 2757. I'm writing it here. Okay. Wait. It's 2757. Now, wait. Out of this 2757, how much out of this 2757, how much profit is related to NCI? How much profit? It D60. Remember the D60 cell, D60 cell, D60 cell, D60 cell. It's 118. Out of this 2757, 118 belongs to NCI. So how much relates to P company? 2639. Okay. So one thing is done. Now let's do the same thing for total comprehensive income. How much is the total comprehensive income? If we own everything, it's 7557. 7557 is the total comprehensive income as if we own everything. Now, what is the total comprehensive income share for NCI? What is the total comprehensive income share for NCI? It was cell number D64. It was cell number D64. Can you calculate the remaining difference? Yes. So finally, your income statement is done. Finally, your income statement is done. Finally, your income statement is done. Your income statement is done. I know the Excel work is a little bit time consuming. It's little bit time consuming, but still it's better you practice. Better you practice on Excel and software, right? Okay. Because in the examination you have to do. So think like in this language. Think in this language now. And I'm sure you all are doing practice on software. I'm sure you all are doing practice on software. Did you understand the question till now? Can you write in the chat box, please? Did you understand in the... Some people are asking about time management. The time management, it's about practice. The more you practice, the more speed will increase. And avoid unnecessary working. Avoid unnecessary working. Some workings you can do in the brackets as well. If somebody wants to see this class again, the recordings will be available. Don't worry. If somebody wants to see this class again, the recording will be available. Now, one last requirement, easy requirement they are asking, and that is about total assets. The requirement B is about total assets. Okay. So in the question, I told you to take the picture. In the question, they gave you total assets of P company and S company, and thank God they have already cancelled out the investment. They have already cancelled out the investments. Remember, S company's investment. So you need to add both assets and then you need to adjust few things. Listen. What is PERT company's assets? What is PERT company's assets? It's 297,310. 297,310. What is S company's assets? It's 110,540. Please keep the question with you. Now, the next thing is important. You remember the goodwill? Honestly, I taught you with the sketch today. Today I taught you with the sketch that SOFP is always as at. So your initially your goodwill was 3,200, then minus 400 1 year and minus 300. In the first year there was impairment of 400. In the second year there was impairment of 300. So now you tell me how much goodwill is left. Even you guys told me it was 2,500 goodwill. Now then you have, I have written separate sections, so you can do like this as well. You can do like this. Wait. You write 3,200 here and you deduct 700 impairment here. Both things are correct. In one line you can do, or you can do in 2 lines, no issue. Then you have some unrealized profit. Unrealized profit, remember, of 600. Then you have some intra-group cancellation, receivable and payable cancellation of 7,000. And then you have upward revaluation of 4,800. Parent companies 4,100 and 700 S companies, so upward revaluation of 4,800. And in asset side, S companies, everything is 100%. Okay, asset side. So let's add it. So it's 4077,550, 4077,550, 4077,550. Okay. Did you understand this part? Please write on the comment box, chat box. Please, all of you comment. All of you comment, please. And now the good news is this is the very latest past paper. Just think, this is the latest fashion. This is the latest thing examiner is testing. So if you can understand this thing, you can also easily do the paper. Give a positive message to your mind. Don't think negative, because if you think negative, everything will be destroyed. And one thing I would like to tell you from the bottom of my heart, that right now, the whole majority of the world is crying. You see Russia, you see Ukraine, you see Pakistan, you see Sri Lanka, bankrupt Sri Lanka, bankrupt Lebanon, you see Bangladesh. So plus all over the world, inflation is high. Inflation is high. So it's a difficult time for everybody. So you guys can support your parents by just clearing the paper in first attempt. At least you should not fail. At least you guys should not fail at all. This is the request, because it's a tough time for everybody. So don't waste a single day. Make a schedule, make a timetable, and meet positive people. The most important thing in the last 30 days is don't interact with negative people. Okay, so don't worry about it. I'll send you this Excel file as well. I'll send you this Excel file. Take a 5 to 6 minutes break, and then we'll start ratios. Then we will start ratios. Okay, don't worry about it. This transaction was not cash in transit. This cancellation was not a simple cancellation was there in this question. We'll start in 5 to 6 minutes. Okay. So now let's move to the next question. Next question is about ratio analysis. And I will again say this is the latest past paper, very latest past paper. If you concentrate, if you do it in a proper systematic way, you can easily answer. You can easily answer. And I never say to score 100 marks. Don't intend. If you score 70% marks, that's also very good. That's also excellent, right? If you score 60% marks, still it's very good. So think like that. Don't get demotivated if you don't know any requirement of 2 marks, 3 marks, like 5 marks. Still you can, out of 20, you can do 15 marks good. Think in this way, okay? Now, this scenario relates to 2 requirements. This scenario relates to 2 requirements. Treats company manufactures confectionery. The following are the sets. First of all, they have given you, see, confectionery, that means they are in the food sector. They are in the food sector, like bakery items or something. They are in the food sector. And you know, they are dealing with perishable products. Food items are normally perishable. So keep your business sense on. Now, obtain for the, this is the year end. Always the year end is also very important. The year end is also very, very important for you. Now, these ratios are for sector average. These ratios are for sector average, industry average. Okay. So obviously now we'll be calculating all these ratios. We will be calculating all of these ratios. Listen to me. And then we'll compare it with the sector average and then we'll comment. That's it. That's it. Okay. Now, see, you have revenue, cost of sales, income statement, and then you have the SOFP. You have the SOFP. See, the SOFP is also there. The SOFP is also there. Student, can you see? Now, you have some notes. Definitely, they are important. The property, plant, and equipment relates to retail stores operated by Treats company and the manufacturing plant. Okay, so the name of our company is Treat Company, and Treat Company also has direct retail store. They sell directly on the retail. Okay, they have their own retail stores and manufacturing plant, all of which are depreciated on a straight line basis over 20 years. The original cost of these assets was 637.84, and the directors, see, very important, are now considering replacing and updating much of the plant and equipment. That means what the message is, we have very outdated, very old assets. That means we bought assets many years ago. So now they have depreciated, and they have a very less NBV left. They have a very less NBV left. Okay. So when they have less NBV left, and now we'll replace. So now our carrying value of assets will go up because the new assets, they will be on full cost. And with the new asset, the amount of depreciation will right now 0. So our carrying value of assets will increase suddenly. Our carrying value of assets will increase suddenly. Now wait. You remember this ROCE, return on capital employed? The formula is PBIT divided by capital employed. And one of the formula for capital employed is total assets less current liabilities. I'm sure you know this. Total asset minus current liabilities. One of the formula for capital employed is total assets less current liabilities. Now use your brain. Just think when we are currently using extremely depreciated asset, our assets are extremely depreciated. So that means the carrying value of our current assets are low. The carrying value of the NBVs or carrying values of our non-current assets are low. So when the carrying value are low, that means the total assets are also low. So that means our ROCE is artificially higher. Normally, when the carrying value of assets are lower, your capital employed is also lower. When your total assets are lower, your capital employed will also be lower. so your rows will be higher. But when you replace your assets, now suddenly you will buy many assets. So your carrying value of the assets will go up, and your capital employed will also go up, and your rows will go down. So in the comment section, you need to write, this is a very valid point. Openly, examiner is giving you a loose ball to hit a 6. You will write that soon when we'll replace the new assets, then this replacement will have a negative impact on return on capital employed. This replacement will have a negative impact on return on capital employed. One more commentary you can write. Listen, there is one more formula of capital employed. Is equity plus debt, equity plus loans, non-current loans. Remember, one formula for capital employed is total assets less current liabilities. The other formula is equity plus loan. Now, I'll show you the balance sheet. Company has very less cash. In the balance sheet. So in order to replace, all you can see, company has zero cash because this company is overdraft. This company is an overdraft, that means zero cash. So now when company wants, listen to me, when company wants to buy new asset, company does not have cash. So definitely company will have to take loan. So in that case, the loan will go up. And when loans will go up, your capital employed will also go up. See, when your loans go up, your capital employed will also go up and your rows will go down. So one way or the other, when you replace your non-current assets, your rows will go down. Or in other words, you can say, when you replace, please don't sleep. This is the commentary, because when I'll go to the solution section, I won't explain. When you listen to me again, when you replace your non-current assets, your capital employed will definitely go up. And when your capital employed will go up, your rows will go down. Okay. I have a quiz for you. Is there any other ratio formula in which we use capital employed? Yes, asset turnover. Very good. So the same commentary you can write for asset turnover. You know, asset turnover formula. It's sales upon capital employed. Okay. So whatever discussion I told you for rows, the same discussion goes with asset turnover, because when capital employed will go up after the replacement of asset, when capital employed will go up, your asset turnover will go down. Now, my respectable student, there is one more point for this. One more angle I can show you. For this point number one. You know, for this point number one, when you are using old, extremely depreciated asset, you know, when you use old car, then you have to go to mechanic every week. When you use old, outdated cars, you need to make friendship with the mechanic. So your repairs costs and maintenance costs are also high currently, because as you are using highly depreciated asset, so your repairs cost and your maintenance cost is also high, and that's why your operating expenses are higher. In the question, you need to comment that your operating expenses are high because you are using old and outdated assets, and it is normal with old and outdated asset that you need to incur more maintenance costs and more repairs costs. Okay, so this point you can also write. Please be active. These are scoring marks, I'm telling you. Now, treat companies paid a dividend of 7.14 million during the year despite the concern raised by some directors over the existing overdraft. Yes, this is the question mark. This is a bad decision. This is a bad decision. See, the company already is an overdrawn. The company does not have positive cash balance, and still they are distributing big dividends, 7.414 million dividend. So this does not suits the company. This does not suits the current financial position of the company. Okay. And one more thing you can write, they might be giving extra dividends to attract shareholders. Sometimes company gives extra dividends to attract shareholders. This you can also write. Number 3, the overdraft is used for working capital management purposes and does not form part of the long-term financing. That's a good thing. That's a good thing. As overdraft is a short-term source of finance, so it is used for short-term investment like working capital. Okay, working capital. But again, one thing is dangerous. As compared to a normal liability, overdraft is the dangerous liability. Overdraft is the dangerous liability. When I teach overdraft, I teach this in my class, that overdraft is always repayable on demand. Overdraft is always repayable on demand. So it's a dangerous liability. And presence of overdraft in your books, is like a black dot, is like it's not good, because investors don't consider it as a good sign that you have overdraft. Okay, so overdraft is not a good sign at all. It's a dangerous liability. It's repayable on demand. It can disturb you anytime. Overdraft can disturb you anytime badly. Then treats company sell its product. This is a very good point. Treat company sells its product through supermarket chains. In addition, its own retail stores. Most of the companies in the sector exclusively sell through their own retail store. Big issue, and the most comments I'll write on it. Listen, we first of all consider us. We produce goods and we have our own stores, as well as we supply to supermarkets as well. We have our own retail outlets. We are treat company. We have our own retail outlet as well as we supply to supermarkets as well. But other players in the industry, they just have their own retail outlets. So there is an issue of comparison. Our books and the sector average books are not comparable like with like. In the end, in the conclusion, you will write this. You are not getting. My dear student, we are providing sales to two people. We have our own stores, retail stores, as well as we are supplying to supermarkets as well, But our competitors, the major competitors, the major industry players, they just have their own stores. So this comparison is not like with like. One more thing I would like to address here. In retail stores, when you sell through your own retail stores, we always do cash sales. All over the world, this is very common. In retail stores, you always do cash sales. But when you supply to supermarket, like for example, Walmart, in United States, if you supply to Walmart gives you money after 7 months. Walmart is a big giant. So they just blackmail you. There are some big stores in United States. They just blackmail you. They say, okay, take it after 8 months or 9 months or so. So always remember that our books and the industry players' books are not directly comparable, because they are only doing cash sales and we are doing cash plus credit. Sales. So I'll be writing some receivable days commentary. And in that I'll write that our books are not comparable with industry players because they are not doing credit sales overall. Okay, now first requirement is total free marks. That means they are giving you in your pocket. They are giving you 5 marks. Just take it. Just take it. So in the last exam, the passing marks was 45 because this 5 marks was total free. In your last exam, the passing marks was 45 because this 5 marks was total free, and whoever can't do this 5 marks should be hanged till, you know what I mean. So if you can't do these 5 marks, basic 5 marks, you are good for nothing. I should make a vlog for you then. I should make a vlog for you with your pick. So in the last exam, the passing marks was only 45. Now student, let's read the requirement. Calculate the treats company equivalent ratios for those provided for the confectionery manufacturing sector. Okay. Now just need to calculate. The pro forma table relating to part A has also been replicated in the question scenario for your information. So we need to calculate these ratios. Simply, now you tell me return on capital employed is PBIT divided by capital employed. PBIT divided by capital employed. Let's pick. What is your PBIT? PBIT is this profit before interest and tax. This is your PBIT. This is your PBIT 7466. 7466. Open your eyes and ears. 7466 is your PBIT. Now what is capital employed? Capital employed is total equity, shareholder equity plus non-current liabilities. Shareholder equity plus long-term liabilities. Okay. So let's do it. Now listen, I have copied many things. And now one more thing. I'm not using Excel or anything like that, because in Word, listen, in ratios, you just have to type. You just have to type the commentary. Just typing the commentary, nothing else. In ratios, there is no Excel work. You just have to type the commentary, and you have to show these ratios using a table. You have to make a table and then you have to show it. So it's not a big deal. Honestly, it's not a big deal. So right now I have copied many things, unnecessary things. I have already write it here. So the first thing is PBIT. The first thing is PBIT. Wait. The first thing is PBIT divided by capital employed. So what is your PBIT? PBIT was 74. Let me open the question here. Yes, it's 7466. Wait, 7466 divided by shareholder equity 25968 plus 33621. Okay, multiply by 100. So it will be 12. Wait. It is 12.5%. It is 12.5%. It is 12.5%. Okay. Now, asset turnover is, I request you guys to take the picture of the question, so it will be easier for you. Okay. Take the picture of the question. If anybody of you wants to take the picture, take this picture, please. Wait. So it will be easier for you. See, all of you, please take the picture. All of you, please take the picture, because I will have it. I can't move the screen. Okay. Thank you. Now the next thing is sales divided by capital employed. Students, go and check the sales. Sales is 214553. Sale is 214. See, this is the second ratio. Asset turnover 214553 divided by capital employed is shareholder equity. I'll explain this overdraft interest. Don't worry, I'll explain. Don't worry. Remind me, I'll explain. 214553 divided by 25968. My dear student, again you have to write the capital employed plus 33621. This is going to be 3.6 times. 3.6 times. Okay. Then next is GP margin. GP margin. You have to show the ratio working. Yes, you have to show. Then GP margin is GP upon sales. Gross profit is 106,544. 106,544. You have the question, you can see. Divided by sales is 214,553. Into 100. This is 49.7%. 49.7%. Okay. Now operating profit margin is 7,466 is your operating profit. Divided by sales is 214,553 multiplied by 100. So this will be 3.5%. Okay. Then current ratio is current assets upon current liabilities. Current assets upon current liabilities. So 47,996 is your current assets. 47,996 is your current assets. Divided by current liabilities is 50391. So this will be 0.95 is to 1. Student, can you please see the screen? Then you have inventory holding period in days, inventory days. So the formula is closing stock divided by cost of sales into 365. Closing stock divided by cost of sales into 365. So closing stock is 30393. You can check the question. I told you to take the picture of question. Divide by cost of sales is 108,009 into 365. So how many days are there? 103 days. 103 days. Okay. Then we have gearing ratio. And in the gearing ratio, in the question it is written, gearing is debt. See, gearing is debt divided by equity. See the formula they have given you. Debt divided by equity, that means debt equity ratio. So how you going to do it? You will write total debt. What is your total debt? Your total debt is 33621. 33621. And what is your total equity? Is 25968. 25968 multiplied by 100. It's more than 100% here. It's more than 100% here. Okay. Then we have receivable days. How are you going to calculate the receivable days? Receivable days is closing debtors. Closing debtors. What is closing debtors? 17603 divided by sales is 214,553 into 365. It's going to be 30 days. That's it. That's it. Your requirement, your question done. Your 5 marks done. No need to do works. Nothing to be done in Excel. For ratio analysis, nothing to be done in Excel. You just have to make a table. In your software, there is a table option. Make a table and just make columns and rows and just solve it. That's it. Just the way this is the table. See, this is the table. Or sometime examiner gives you ready-made table in which you have to work. Sometime examiner gives you ready-made table in which you have to write. Student, tell me honestly, can't you do this ratio calculation? Can't you do this ratio calculation? This is super easy. This is total F3 level or F2 level. All of you can, it's easy. And you know one bad luck. Sometimes there are students, they don't manage the time. There are students, they don't manage the time properly and they just solve first 80 marks and then they leave the 20. They leave this easy marks. They can't reach till this question, just think. And this was the 3 marks in the question. So now let's move to the commentary section. Read the requirement. Examiner is saying analyze the performance and position. you know, performance means performance is a for the year thing, and position is as at. Okay. So in the performance, you have ROS, return on capital employed, profitability ratios like GP margin, operating margin, these. Okay. And in the financial position, you have the gearing, you have current ratio, inventory days. These are the financial position. These are the balance sheet ratios. Okay. Right. In comparison to its sector average. Now, wait. Just make your mind. This is 15 marks question. You can score 10 marks only. That's it. In theory, you can't. There are students. Yes, there are students. They are exceptionally good. They score 14 marks. They score even 15 marks. They score 13 marks. But we are common men. Me and you are common men. We can score 10 marks. That's it. We can score 10 marks, and then again we'll say thank God. That's it. This should be the approach. Then you will feel motivated. If you go for one mark, and then you will never feel satisfied, and then you can't give a good message to your mind. Okay. Now, first thing is, let's start with the GP margin, because we will be discussing performance ratios first. So I request you to don't sleep next 25-30 minutes. Is not for sleep. Please give some energy. Now, we have a GP margin. We have a GP margin of 49.7%, but the industry average is 55%. We have a GP margin of 49.7%, but the industry average is 55%. So our GP margin is little bit lower than industry average. What is the reason? Let me tell you the reason. Open your eyes. Majority players in the industry, they directly sell to general public. It was written in the question that majority players in the industry, they have their own retail outlets, so they directly sell to the public. But what we do, we have some retail store as well as we give it to supermarket. So just think, we give to supermarket first and then supermarket sell. That means supermarket also has to earn. So when we provide things to supermarket, we can't charge high profits. We cannot charge high selling price, because one more step is there. Supermarket also has to earn. So other players in the industry, they are directly selling. Other players in the industry, they are directly selling to public, so they can charge higher prices. But as we are selling to a middleman, which is supermarket. So our prices will be lower compared to that. And I taught you in the class, when your selling price is lower, your GP margin is also lower. So one reason for a slight, it's not a big difference. 55 and 50 is not a big difference. One reason for this slight decrease is that we sell to supermarket as well, but the other players don't sell to supermarket. This is the first reason, and a valid point. Now, second general discussion I can do. Even we have a 50% GP margin, which is very good. Even we have a 50% GP margin, which is very good. Why the GP margin 50% is considered good and not bad? Why it's a good GP margin? Because we are not only selling to, listen to me, we are not only selling to public, but we are also selling to supermarkets. So we have a large scale of production. We have a big scale of production. And when you produce things in bulk, you get economies of scale. You get economies of scale, and that's why your cost is lower. So that's why 50% good GP margin, you can avail it. A good GP margin, you can avail it. Okay. So this type of discussion you can do. Don't worry, I'll show you the solution. But first, make up your mind. Then another thing is, there is a big difference in operating profit margin. See, operating profit margin of the industry is 12%, but we have only 3.5%. Operating profit margin for the industry is 12%, but we have only 3.5%. We have only 3.5%. Why? Just start the discussion. First thing, it means, see, the condition till GP was perfect. The condition of our condition as compared to industry, as regard to GP is good. GP margin, not the big difference, but with operating margin, there is a big difference. But that means the expenses are high. That means the expenses are higher. That means the expenses are higher. Expenses are higher. Okay, right? And we can say the expenses are not in our control. Our expenses, operating expenses, are not in our control. And you know, one reason for high operating expenses, let's connect the dots. This is the most important thing. If you connect with the scenario, if you connect with the scenario, this is the most scoring thing. But if you do general discussion, you won't get much marks. Okay, so you know, our operating profit margin is down because our operating expenses are higher. And why our operating expenses are higher? Because we are using outdated assets, we are using old assets, we are using extremely depreciated asset. And this is very common with the extremely depreciated asset, that you have to spend high maintenance cost and high repairs cost, which are part of operating expenses. I hope you got my point. Are you getting? One more thing. The return on capital employed, the return on capital employed for industry is 28.8%. Be confident, be confident. You have to win. You have to win. Treat yourself as a winner. Give this message to your mind. Write on your mobile phone home screen, F7 clear, F7 clear. Okay. Give this message. Industry average is 28.8%. Industry average is 28.8%. And your ROS is 12.5. So it's less than half. It's a big difference. Return on capital employed is lower. So now you need to discuss about the return on capital employed. You know, in my classes, in my ratios classes, I always say this formula: ROS is the product of asset turnover and operating margin. Remember this: ROS is the product ROS is the product of asset turnover and operating margin. ROS is the product of operating asset turnover and operating margin. So ROS is dependent on these two. Now look at these two, please. Asset turnover is very good. See, industry average is 2.4 and our asset turnover is 3.6 times. So this is perfect. This is perfect. So what is the bad? What is the bad thing? This is the bad thing. Our operating margins are lower. That's why our ROS is lower. So the reason, you have to write this, it's scoring marks. The reason for the decline of this ROS is the decline of operating margin, is the decrease of operating margin. Okay. And one more thing, which I told you in the beginning of this question, when I was reading the question, which you remember, I told you it is given in the indication has given in the by the question, by the team, that soon in the near future they are going to replace their property, plant and equipment. Soon in the near future they are going to replace their property, plant and equipment. And when they will replace the property, plant and equipment, their capital employed will go up. When they will replace the property, plant and equipment, their capital employed will go up and their ROS will further go down. So that means be ready. Be ready, investors. Be ready. Your ROS is going to be down in future. Your ROS is going to be down in future. Be ready. Your ROS is going to be down in future. Okay. Wait, let me tell you this thing I taught you. See, students, this thing, because as we don't have any cash, we are already in overdraft. So when we buy new assets, we'll have to take loan. We'll have to take loan, and when our loans will go up, our capital employed will go up and ROS will go down. So there will be a further deduction in asset turnover and ROS in future. There will be some deduction in asset turnover and ROS in future. I told you this during the discussion. Then you have, my dear student, you can see the current ratio. Our current ratio, the industry, I'm talking about something discussion on position. Current ratio is 1.8:1, but we have only 1.95:1. 0.95:1, 0.95:1. Okay. So the reason this is the downfall, and this shows that the liquidity position of trade is not good. And even it's so bad that we have shifted ourselves to overdraft. We have shifted ourselves to overdraft. And yes, overdraft is a current liability. Overdraft is the current liability. So, you know, why our current ratio is lower? One reason is our current liabilities are higher because of overdraft. And again, overdraft is not a good sign. Keeping overdraft in your books it's not a positive message to the shareholders, because overdraft is an expensive source of finance, and overdraft is always repayable on demand. Overdraft is an expensive source of finance, and overdraft is always repayable on demand. So in terms of liquidity, we are not better. One more thing, if you can see the question, please. If you can see, out of in the current asset section, we have high inventories. We have high inventories 30393. Out of total current assets, there is a major portion of inventory. So why we are holding high inventory? Can anybody tell me? Because we are selling goods to supermarket, and you know, when you sell goods to supermarket, that means you are answerable. Sometimes they demand and we have to give immediately. So remember, there is a word uncertain demand. In my lecture, sometime I use this word when I teach ratios. Uncertain demand. Okay. So if there is an uncertain demand, so you need to keep extra stock. This is the possibility. That's why we are keeping extra stock, to satisfy the supermarket people, to satisfy our supermarket audience. One more thing. Can you see, compare the inventory days? Can you compare the inventory days? The inventory days are 25 days for the rest of the sector, and for us it's 103 days. It's too much. 103 days is too much. So this needs to be investigated, and this is extremely dangerous. Why? Because we are in food sector, confectionery. See the word in the question, confectionery. We are in the food sector, and we have perishable goods. We are dealing in perishable goods. So when you are dealing in perishable goods, so it's extremely dangerous. When you are dealing in perishable goods, then it is extremely dangerous. Your stock will be obsolete. You will have high stock losses. So this is alarming for them. Yes, very good. High storage cost. Somebody has written in the comment box, when you keep a lot of inventory with you, so you need refrigerators and special conditions, special temperature things you must have. So this will add to your holding cost as well. Now the next thing is receivable days. In the market it's 15 days, but for us is 30 days. Other competitors have 15 days. Industry average is 15 days. Our have 30 days. Why? Because they are doing only cash sales. Majority of the players are doing cash sales. They might have some players with little credit sale, but we are doing goods. We are doing sales to supermarket. And when you do sales to supermarket, you have to allow them credit period. When you do sales to supermarket, you have to allow them credit period. Okay. I give you example of Walmart. You know, Walmart is such a giant store here in United States that if luckily if you get a one product for Walmart, let us say Walmart allows me to keep this pen on the Walmart shelf, then I don't need to do teaching. Then my next generation does not need to do. Walmart is such a big giant, whatever you supply, they sell it. Everybody goes to Walmart. It's a very big store. It's a very big store. So if luckily we got a chance to get one product on the shelf of Walmart, we don't need to do teaching then, honestly. But yes, Walmart is such a big giant that Walmart blackmails all the supplier. You know what Walmart says? Walmart says, give your products and we'll pay you after 1 year. We'll pay you after 1 year, because Walmart is a giant. And so the suppliers are dependent. They have to give them 1 year or 18 months credit. Even some of my relatives, no bad debt risk. Walmart is a big giant, no bad debt risk, but your money is tied up. But your money is tied up with Walmart. So a normal supplier can't deal. Even some of my relatives were supplying to Walmart, and in the end they were tied. They said it's very difficult to give 1 year credit or 1.5 year credit. Are you getting? So let me come back to the topic. This is the normal question. Walmart is very big example. Leave it. So when you supply to supermarket, you have to give credit sales. You have to give credit sales. That's why. So one more thing you will say, that this comparison is receivable days, comparing receivable days with industry, comparing receivable days with inventory is not like with like. Comparing receivable days with the industry is not like with like, because the other players are not doing credit sales. Okay, getting the point? Then you have gearing. Industry average of gearing is 43% and our gearing is 129%. So that means we are highly geared and we have taken a lot of loan. And high gearing means high financial risk. High gearing means high financial risk. And when we have taken lot of loans from the market, that's why our interest cost will be higher. And when our interest cost will be higher, interest is the financial fixed cost. So we all know fixed cost increases the risk of owner. Fixed cost increases the risk of owner. So this is very dangerous. And one more thing you will write. As in the question, there is an indication given that soon in the near future, we have to buy new assets and we don't have cash. So there's a high probability we'll be getting more loans. There is a high probability that we will be getting more loans. And when we'll be getting more loans, that means more gearing in future, more gearing and more financial risk in future. Okay, so I have discussed many things. In the end, you can write the conclusion. I'll tell you what to write. So now let me show you the discussion, what I have explained you. I have written in simple language. What I have explained you, I have written in simple language, and then you can walk through it. But I hope you understood major points. Okay. Listen, this is the first area in which we are discussing the performance. Okay. So the first thing is GP margin. C. Treat company's GP margin is lower because treat company also sells to supermarket. That's why the prices should be comparatively lower compared to the general public. Okay. But the breakup is not given for supermarket and general public sales. Yes, this, you have to play with this information thing. This is a very good idea. I've seen in many past papers, even I've seen in other qualification as well. Listen, just write a commentary and then come back, take U-turn. Inform examiner that we know this thing and then take a U-turn. See, read this word. But the breakup is not given for supermarket sales and general public sales. Supermarket sales and general public sales breakup is not given. Breakup is not given. Breakup is not given. So you have told examiner, but in the end you took the U-turn. You said breakup is not given. Otherwise we would have discussed more. Otherwise we would have discussed more. This would be more beneficial. But still the GP margin is about 50%. This I told you, which may be due to economies of scale because of large operation. See, our GP margin is 50%. 50% is considered to be a good one. So why it is good? One reason is we are selling to many people like supermarket as well as direct retail. So we have a large operations, and with large operations, there is economies of scale. So that's why our costs are lower. Our production cost is lower. So GP margin is higher. So this is the first paragraph. I have explained you everything. Listen, this is just you are reading. I have explained you already. Then the next thing is operating margin. Operating margin, listen. But operating margin are far less than industry average. Obviously, the 12% is the industry average and we are at 3.5%. Maybe due to poor cost control. One reason for less operating margins are old assets which require more repair and maintenance and may incur more impairment. Yes, see, as we have outdated and old assets, so they require maintenance, they require repairs. And yes, obviously, when they are very old, so we need to do impairment testing and so more impairment as well. So that's why our operating expenses are higher. This is one of the reasons. This may be one of the reasons, right? Now, ROS is also lower. Our ROS is lower. ROS is the product of asset turnover and operating margin. ROS is the product of asset turnover and operating margin. As I told you, I wrote the formula, my dear student. As asset turnover is higher, so the reason of lower ROS is lower operating margin. The reason for lower ROS is lower operating margin. Okay. Now this ROS figure would drop further. See, I have given indication. In near future, it will go further down. If company would replace new PPE in near future, as no cash with the company, so company would have to take loan for the new PPE. This will have a negative impact on ROS. This will have a negative impact on ROS. I've already told you. And this will have a negative impact on asset turnover as well. After the new replacement of asset, net asset turnover may also go down. I told you through the formula. So this is all you have write for the performance. This is all you have written for the performance. Now the position. First of all, current ratio. Current ratio is lower. And you know, there is an overdraft in the company's book, which is a negative sign. Because I've already explained you, overdraft is always repayable on demand. Plus overdraft has a high financing cost, high interest rate. It looks like company using overdraft for working capital management. Company is using overdraft for working capital management. That means company does not have their own cash. Looks like company holding large amount of inventory. I showed you through the SOFP. And the second evidence let me tell you, when your inventory holding period is higher, obviously you are holding high inventory. When your inventory holding period in days is higher, and that means you are holding higher inventory. So this may be due to deal with supermarket. We need huge amount of inventory to meet uncertain demands. I told you uncertain demands word. As we are dealing with supermarket, that's why we are keeping some extra stock. As we are dealing with supermarket, that's why we are dealing with extra stock. Okay. Also, high inventory turnover days is dangerous because company sells perishable food products. Yes, as we are dealing in food products, as we are dealing in food products, they are perishable. So high inventory days is very dangerous. We have to bear holding cost as well. Next thing, receivable days are twice of the industry average. This may be due to supermarket takes long time to pay. Yes, as we are doing sales to supermarket, that's why it may take long time to pay. Also write the comparison issue. Receivable days ratios not comparable with other industry players because other members doing cash sales in retail sector. Other members doing cash sales and retail sector, and we are doing credit sales. So this comparison is not like with like. This comparison is not like with like. Then you have gearing ratio is higher, which indicates high financial risk and more interest fixed cost, more interest fixed cost. Yes, interest is a financial fixed cost. And as I have already told you, fixed cost increases the risk of owner. Fixed cost increases the risk of owner. If company replaces PPE using debt in near future, then this gearing ratio will increase further. Already explained. Okay. Huge dividend payments of 7.14 million does not suit with the current position of company, as company is in overdraft. Okay. Now, finally, you can write the conclusion. Let me tell you some points. Overall situation of the company is mixed. Overall situation of the companies, as far as GP margin, it's good, but companies gearing and long-term existence isn't dangerous because of high gearing. And in conclusion, normally you demand more information. You can ask that the receivable days breakup is not given, like aged debtor analysis. If we get aged debtor analysis, we can do better analysis. Similarly, for inventory, we don't know the breakup of inventory. Which type of inventory we are dealing in. So if we get the breakup of inventory, for example, if there are some goods which have more expiry date, than 103 days, then it's not dangerous. Nowadays in developed nations, there are companies, they are producing things with big expiry dates, like they last long. Even the food products, there are food products, they last long. So if we have such type of food or something, so then it's not dangerous. So the information is not given. One more thing. Yes, we have taken more loans. Listen to me. But what about the terms and condition of the loans? What about the terms and condition of the loan? Listen, what about the terms? And maybe we have a long repayment date, then it's not dangerous. Remember, like 6 to 7 months back, I remember in August 22 or in September 22, I made a video when there was a lot of noise regarding Pakistan default. There was a lot of noise in the market regarding Pakistan default. So I made one video at that time. And in that video, I showed that Pakistan has low current liabilities. At that time, in near future, there were low short-term debts. So majority debts were long-term, external debts were long-term. So in that video, I proved that it's long-term debts are more, and long-term debts we don't need to pay in the near future. So it's not dangerous. It was that time, okay? It was August 2022. So my dear students, in the conclusion, you will write these things about more information about inventory, about receivable, about the gearing, about the loan, about the conditions attached to the loan, and so on, right? Okay. Now, finally, one of the students asked one question. I need to answer that question. Listen, there's my pen. This is what PBI, for example, this is PBIT. Your PBIT is 5,000. And then you have less bank overdraft interest of 200. Then you have loan note interest of 1000. Now, all of you listen, please. Just for the calculation of ROS, you know the formula of ROS is PBIT divided by capital employed. PBIT divided by capital employed. You remember this? Just for the calculation of ROS, you will take this PBIT. That means just for the calculation of ROS, you need to deduct overdraft interest. You need to deduct overdraft interest from PBIT. That means you will be using 4800 as a PBIT. Although the name of PBIT is profit before interest and tax, but just for the sake of ROS, the PBIT will be after overdraft interest, if overdraft interest is given separately. If in this question there was no separate, overdraft interest was given, listen to me. So if overdraft interest is given separately, then you need to deduct overdraft interest in order to calculate PBIT of ROS only, not for operating margin and other things. Okay. And what is the logic? The logic is in the denominator, as we are using all long-term source of finance. So in the numerator, you will not deduct the cost of long-term source of finance only. You will not deduct the cost. See, this is the long term. You will not deduct the cost of long-term source of finance. Okay. So finally, my final message for you guys is, yes, like with like. My final message for you guys is stay positive, think positive, and work hard in the right direction. Solve the mock exam, read the examiner report. And if you feel demotivated, you just think one thing, that you have studied from Mustafa Mirchawala, then you will definitely clear. Because if you see my history, I have thousands of students clear, and not only clear, they score excellent marks and they score positions as well. So don't worry about it. You have done everything. You have just work hard on controllable factors, and train your mind, give this message to your mind that you will definitely clear, Okay. So stay positive and best of luck for your exams. Allah Hafiz. Thank you.